The succession planning has been going on really since I came back. The three of us, my dad, my sister, and I actually meet once or twice a week specifically to talk about the business and the things from his perspective that he needs for us to be involved with, so that you're having those high-level financial conversations about the company with our strategic partners outside of the business. My sister and I are very in-depth in looking at the financials every month, understanding what they mean for the business, where things are headed, strategic planning. So it's all of those kinds of things on top of our regular jobs, which each of us are running, the two biggest divisions of this company. So we're doing our day-to-day work, but finding those times within each and every week that we can be looking at bigger picture issues and understanding the kinds of things that my dad has been thinking about for 30 years or whatever, so that we can begin to take that on.
Northern Initiatives is committed to entrepreneurs like you, because you are the people who are creating jobs and enabling the communities of our region to thrive. After completing this training, you'll be able to explain how to change the ownership of a business through selling, closing, or transferring the business to successors, explain how to establish an exit strategy for retirement, which includes a succession plan, transferring ownership of the business, and paying taxes, and explain why a business is important for growing wealth and how succession planning supports a business owner's retirement plan.
While many businesses run for years, even over several generations, businesses open and close all the time. Here are a few reasons why you may want to sell or close your business. Business or professional reasons include job offer from another company, purchase offer for your business or your business assets, dissatisfaction with sales and profits, changes in the market or industry. Personal reasons to sell a business include retirement, burnout with self-employment, health concerns or family needs, desire to go in a new direction, as part of a strategic plan rather than a reaction plan. How might you go about selling your business? Before starting, you need to determine if you have a saleable business. Here are some questions to consider when determining if you have a saleable business. Do you have a healthy balance sheet? A combination of good retained earnings and net worth, low debt, and collectible accounts receivable make for an attractive business that's worth purchasing. Does your business have a history of strong profits? A financially strong business has a lot to offer a new owner. If your business is struggling financially, the business will not be as attractive to buyers, especially since it's very likely the buyer will finance a portion of the purchase. Sometimes a business does not even have a market value beyond the assets of the business. Is the business in an attractive industry? Some types of businesses have more appeal than others. Is the business in a location convenient to potential buyers? Location is important to many businesses. Some businesses can be easily moved, others cannot. Are your assets in good shape? Having assets in good condition with significant market value and remaining useful life adds to your business value. Do you have quality inventory and good supplier relationships? A prospective buyer wants to see quality, for example, fresh inventory and solid relationships with suppliers. Do you have a solid customer base? A healthy list of returning customers makes your business more valuable and attractive. Can you transfer your business to another person? Some businesses are dependent on a particular person's talents and cannot be transferred to another person. The value of your business can be determined by many business valuation methods. Most valuations are a combination of two factors: assets, such as cash, receivables, inventory, equipment, and real estate, or revenue stream, that is, net profit over time. Assets are usually priced using market valuation. Valuing revenue stream is more complicated, involving return on investment, comparisons to alternative investments, and growth potential. Many owners get help from accountants, attorneys, and industry specialists when determining the value of their business. When preparing for the sale, here are some items to consider. Resolve outstanding issues such as unpaid accounts receivable, debt, taxes, lawsuits, and environmental hazards. Demonstrate that accounts receivable can be collected. Prepare historical and projected financial statements. Confirm that your tax payments are current. Provide a convincing business plan for the future. Secure beneficial relationships with suppliers and customers. Get the premises in good shape. Sell old inventory. In addition, you must determine exactly what equipment is included in the sales price and make sure all business and office equipment is in good order. Finally, you should provide a clear picture of how you'll be compensated as the owner. Prospective buyers may include employees with enough management experience and skill to take over the business, which may include family members. long-standing customers who might have a passion for your product or service, business owners whose businesses would be enhanced by your product or service, competitors who might see a benefit in absorbing your business. You'll want to advertise online through trade associations, social media, and personal and professional networks to inform potential buyers that your business is for sale. Negotiating and structuring a business sale is a complex process. Many business owners engage the expertise of legal and financial counsel. Here are some of the issues to consider. Buyer qualification. Well, just like buying a home, buyers need to demonstrate the financial ability to purchase a business. Payment in lump sum or installments. Buyers can provide the entire price through a combination of cash and loans from banks or pay the business seller in installments. Non-compete agreement. Often, business sellers are required to sign an agreement to not start a competing business for a few years. Management assistance. The new owner of a business may benefit from the previous owner's expertise. The seller of a business often will serve as a paid consultant or manager for a few months to help the new owners learn how the business operates. Sales agreement preparation. A sales agreement covers many elements of the sale, including sale price, buyer deposit, promissory note, security, seller and buyer's representations, contingencies, dispute resolution, and more. Down payment. If a purchase is to be paid in installments, the buyer and seller must agree on a down payment. Collateral. If the purchase requires a loan, all parties must agree on collateral. So, as you can see, many factors are involved in the sale of a business. You should work with an experienced attorney and an accountant to help structure the deal and prepare all the documentation. Here are a few reasons why it might make more sense to close a business rather than sell it. The businesses might be too small with insufficient assets and profitability to interest a buyer. Businesses in decline are not promising investments. Businesses that are specialized, located in remote areas, or have other unique characteristics may be difficult to sell. Businesses with significant assets but not sales might be better off selling the assets and closing. Use this checklist when closing your business. Follow instructions in your business's founding documents. File dissolution documents with the state. Sell business assets. Cancel permits, licenses, and lease agreements. Comply with tax laws. Resolve outstanding issues with customers, creditors, and suppliers. Maintain business records. Seek help from your accountant and attorney to review the closing process. Succession planning involves creating a plan for someone to either own or run your business after you retire, become disabled, or die. In simple terms, succession planning is the process of passing control of the business to others. What benefits do you see to selecting a successor? What would happen if you weren't able to continue running your business and you did not have a successor? Identify successors. If you're passing the business to a family member, you may consider transferring ownership through your estate planning process. Often, however, new management comes from your pool of existing employees. If you have a larger business, such as an LLC or a corporation, succession planning involves preparing people for management and leadership roles in order to replace you or other managers when the time arises. Finding your replacement is difficult, so plan ahead. It's best to start early. You can hire from outside the company, but it's helpful to groom someone already in your business over a period of time so the transition to new leadership will be smooth. Train successors. Once you have successors identified, deliberately create a training plan to ensure that everyone involved has time to learn the skills, gather the information, and practice the leadership roles critical to the future success of the business. Whether you are transferring a business to a family member or you're promoting employees into leadership roles, you need to plan ahead. A succession plan takes into consideration the development of future leader skills and abilities. Ease tax exposure. Tax exposure arises when one generation gives way to the next generation in a closely held family business. In this case, succession planning and estate planning become intertwined by the family. Multiple types of taxes must be considered when planning this type of succession, including income tax, gift tax, generation skipping tax, estate tax. Start family succession planning sooner rather than later because starting sooner will give you more flexibility with your planning. Consider a backup plan as well, in the event that plans change. Consult an attorney and an accountant about putting the proper estate documents in place, especially for succession planning in a family business. Even if you do not plan to sell your business in the near future, it's still a good idea to be planning for retirement by making regular contributions to a retirement plan. Starting a retirement savings plan can be easier than most business owners think. By starting a retirement savings plan, you'll help not only you, but also your employees save for the future. What's more, retirement programs can provide tax advantages to both employers and employees. You can establish a plan even if you're self-employed. A retirement plan has many benefits. Primarily, it helps you and your employees to save and invest toward financial security in retirement. You and your employees also get significant tax advantages and other incentives. Employer contributions are tax-deductible. Assets in the plan grow tax-free. Flexible plan options are available. A retirement plan can attract and retain employees, reducing new employee training costs. Employee benefits include contributions to the plan reduce current taxable income. Contributions and investment gains are not taxed until the contributions and gains are distributed. Contributions can be easy to make through payroll deductions. Small, regular contributions can grow to significant retirement savings over time as a result of compounding. The earlier in life an employee starts to save, the more they'll benefit from compound growth. Retirement assets can be transferred to a new plan if the employee leaves the company. Small business retirement plans are recognized by the Internal Revenue Service, or IRS, as a means to help employers and employees save toward retirement. There are many retirement plan options available for a small business. There are 3 key types of IRA-based options. Simplified Employee Pension Plans, also known as SEP, are available for any size business. Only the employer contributes to the retirement plan and can contribute up to 25% of each employee's pay. Contributions to a SEP are tax-deductible. The SIMPLE, which stands for Savings Incentive Match Plan for Employees, Individual Retirement Account Plan, allows a business that has 100 or fewer employees to help employees save for retirement. Employees can contribute to the IRA on a tax-deferred basis through payroll deductions. As the business owner, you can choose either to match the employee's contributions or to contribute a fixed percentage of all eligible employees' pay. Payroll deduction IRAs. Even if you do not want to adopt a retirement plan, you can allow employees to contribute to an IRA through payroll deductions. As the employer, you would set up the payroll deduction IRA program with a financial institution, and then the employees choose whether and how much they want deducted from their paychecks and deposited into the IRA. The employee makes all of the contributions. There are no employer contributions. Another retirement plan option is defined contribution plans, such as a 401k plan or a profit-sharing plan. For example, a 401k plan allows participants to decide how much to contribute to their accounts, and employers are entitled to a tax deduction for any contributions they make to employees' accounts. Banks that provide 401k retirement savings products will generally assist you in setting them up and even provide education for your employees on important features of the plan. Review the options available to you with your CPA. Contact a plan administrator to open your small business retirement plan. Ask your bank, accountant, or business attorney if they have firms they can recommend that function as plan administrators. If you have employees, notify them about the plan, its provisions, and eligibility guidelines. Ensure employees can contact plan administrators with any questions they may have regarding the plan. Then, integrate contributions to your regular business and financial management practices. Retirement savings can and should be built into your overall business plan to ensure sufficient profits for retirement saving. Transitions that include selling a business, closing a business, and retiring are all part of the life cycle of a business, and you should prepare for them. If you are just starting your business, you may not need to focus on these transitions right away. However, when you feel you and your business are in a steady state, give some thought to these transitions and start your plan. It's a good idea to be saving for retirement regardless of how many years away retirement may be. Small business retirement plans are a means to help employers and employees save toward retirement.
The advantages of buying an established business, I would have to say, as long as it's a business that's doing well and people seem happy to come there, even if it's not a business that's doing well, if you have the passion to make it grow and to keep evolving it, I think that's a great thing. My advantage was we had a good clientele already. I had already worked here for about 4 years, so I had a clientele myself. And I think people were very encouraging to me purchasing it, and my my coworkers at the time were very encouraging as well. The advantage of buying an established business for me was that I already had an established clientele and the business already had an established clientele. So therefore I knew that it was going to, if we just kept evolving, that we would continue to grow and we would be able to keep our clientele.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and care a bit more because it's not profit for us, it's prosperity for all.